My name is Peter Duke from Fidelity. I'm delighted to be here at the FundFOrum in Dubai and delighted to be with Mohammed Al Khaja from OSOOL, Head of Asset Management. Mohammed, welcome.
Thank you.
First question, as an institutional investor, perhaps you could just talk a little bit about your risk return expectations from the investments that you manage.
Thank you for welcoming me here. Given that our clients are pension, the risk for our clients is actually not achieving their target returns and not covering their liabilities. And hence the way they look at risk is completely different than the traditional clients. We need to make sure that the client meets certain milestones in the future, have a minimum reserve ratios in the future, which leads us to tweak our asset allocation a bit and reflects on our philosophy and our beliefs. We believe that leads us to believe in private markets more than public markets, believe in active management more than passive management, and again that all filters down in the asset allocation we have.
And in terms of that asset allocation and looking to meet your objectives, can you talk a little bit about what that looks like from a strategic point of view?
So broadly, we have 40% in equities, 20% in fixed income, and 20% in alternatives. Alternatives include hedge funds, private equity, but infrastructure as well, and anything that is not correlated with the rest. We included infrastructure recently due to the nature of the asset class, the longevity of it, the yield expectation, obviously the lower volatility relative to other asset classes. And that's how broadly it looks. Probably one of the other changes that we have, which is not reinventing the wheel, but the way we look at hedge funds within the portfolio. We don't look at hedge funds as a separate asset class, but rather dissect that into equities, credit, and others, which is helping us in our asset allocation.
And within that asset allocation, what's the view on local markets, equity, fixed income, and property? Do you have a strategic allocation to those areas? And if you do, what's the rationale behind that?
We have a requirement to have 50% of the assets locally, regardless of the asset class, whether it's equity, fixed income, or alternatives. We don't trade the local market, but rather look at the local companies as either strategic or non-strategic. So we'd only invest in companies that are strategic for us and for the client's future. The local fixed income, obviously, given where the economy is heading, is yielding higher returns than the international. We are from the local market, we understand it better, and we accept the risk, and hence obviously we're exposed to local and regional credit, which are better yielding at the moment.
Yes.
But we don't necessarily have a specific, other than the overall 50%, we don't have a specific target per asset class to be in the region.
And we're talking about strategic long-term. In terms of tactical short-term views, particularly recent volatility, what keeps you awake at night, if you like, or what risks are you actively assessing and you believe are genuine for the world going forward?
The risk from our view, we're not going to necessarily focus on the tactical risk, but the long-term risk. As you said, we're long-term clients. A couple of issues. One of the issues is obviously politics and how politics are entrenched within the economy these days. It's not about an economic decision or an economic outlook, but rather every single political decision that is made by any major country affects how the world is moving and the economy is moving. And that's something that you can't necessarily predict, and that worries us a lot. How much is that getting more and more part of the new reality? The other issue is obviously, if you look at history tells you you'll have a recession once every 7-8 years. We're heading there. Where is that going to be? That's a worry. And more so because of the new reality. The whole world is dependent on the new QEs. All central banks are venturing in that area, and they themselves don't know how it's going to unbuckle. It might lead to an ugly situation. I'm not saying necessarily it's going to be, but the uncertainty there worries us a lot.
And specifically then with that unwinding of QE and the reaction of markets to unconventional policy, how do you mitigate against some of that risk? I mean, how do you provide proper diversification but also some protection?
I don't think anybody can mitigate that. similar to, if you look at, what happened to Lehman. People thought it's going to be limited to a certain amount, sector, area, and obviously the ramification of that was way more than what people expected. Probably similar thing will happen if anything wrong happens with Brazil these days, and people talk about Brazil and how that's going to unfold. So I don't think anybody can necessarily mitigate completely the effect of the QE on anybody. That's just massive, too big, affects everything in the economy. However, we try to go more, as I mentioned, on the private market, or try to find strategies that are truly uncorrelated. And there we're talking about strategies like ILS, insurance-linked strategies, where the outcome is completely non-dependent on financial markets, but rather a natural disaster happening somewhere. This is truly uncorrelated. Now, the problem there is obviously you don't have enough strategies to diversify, and each of these strategies have limited capacity. But this is part of where we spend our efforts, is can we find strategies that are truly uncorrelated, not only necessarily on paper, because obviously, again, history tells us if we have another 2008, everything goes to one. We're trying to find things that can truly be uncorrelated, which is another challenge by itself.
Which keeps you busy.
Most of our energy.
Mohammed, thank you very much for your insights. Enjoyed the FundFOrum, and
thank you for your time.
good luck in interesting times ahead.
Thank you for receiving us.